All right, let's dive into something fascinating. We're going to pull back the curtain on modern companies to figure out where their real value is hiding. We're talking about accounting for the invisible.
So let me ask you something straight up. When you picture a huge, successful company, what do you think is its single most valuable asset? Is it their giant headquarters, all their factories, the stuff in their warehouses?
Well, for so many of the world's biggest companies today, the answer is nope. Their most valuable assets are things you literally can't see or touch. We're talking about incredibly powerful brands, game-changing patents, copyrights, and all that unique software. These are really the engines of the modern economy, which, leads us to this huge challenge for accountants everywhere. If a company's worth is all tied up in ideas and relationships and legal rights, how on earth do you put a number on that? How do you even begin to account for it? Well, luckily, there is an answer, and it comes in the form of a global rulebook. It's called International Accounting Standard 38, or IAS 38 for short. This is the playbook that tells everyone how to handle intangible assets. So here's our plan. We're going to follow the life of an intangible asset, from start to finish. We'll look at what they are, how they even get on the books, what happens to their value over time, what gets left out, and then finally, why any of this really matters. Okay, so first things first. How does something totally abstract, like a brilliant new idea or a clever bit of software, make the leap to becoming an official, valuable asset on a company's books?
Before we go any further, we need the official definition. According to IAS 38, it's an identifiable non-monetary asset without physical substance. Now, every one of those words is doing some heavy lifting, but that word identifiable, that one is absolutely key.
And to prove something is a real asset, it has to pass this really strict three-part test. First, is it identifiable? That means you could either sell it off separately or it comes from some kind of legal right, like a contract or a patent. Second, does the company actually control it? Meaning, can they get all the good stuff from it and, this is crucial, stop anyone else from getting it? And third, is it going to make you money in the future, either through more revenue or maybe lower costs? If you can't check all three of those boxes, then sorry, it's not an asset. Now, here's where it gets super interesting, especially if you're an innovative company. IAS 38 actually splits internal projects into two distinct phases. You have the research phase, which is just seen as a cost of doing business. It's an expense. But once you move into the development phase, where you're actually building a specific product, then you can start treating those costs as an asset. But there's a big catch. You have to meet 6 very strict criteria, proving things like it's technically possible and you actually plan to finish it and sell it.
Okay, so let's say our intangible asset passed the test. It's officially on the balance sheet. Great. But what happens now? Its life is just beginning. How does its value get tracked over time? The key term to know here is amortization. And honestly, if you get how depreciation works for things like buildings or equipment, you're already 90% of the way there. Amortization is just that same idea, spreading the cost of an intangible asset out for its useful life. But not all intangibles get the same treatment. The rules make you decide if the asset has a finite life or an indefinite one. Something with a finite life, like a patent that legally lasts for 20 years, gets amortized over that period. But an asset with an indefinite life, like a huge, famous brand that could keep generating value forever, well, that's not amortized at all. So, if you don't amortize it, does that just mean its value sits on the books at full price forever, no matter what happens? No way. Instead, it has to get an annual health check. It's called an impairment test, and it's where the company has to prove the asset is still worth what they say it is. If, say, a brand's reputation takes a massive hit, its value has to be written down on the balance sheet. And that brings us to one of the most important, and let's be honest, often misunderstood, parts of these rules: goodwill, and all the other valuable stuff a company isn't allowed to put on its balance sheet. Wait a second, I know what you're thinking. Didn't you just say a brand could be an asset? Yes, I did, but here is the critical distinction. IAS 38 says you absolutely cannot recognize internally generated brands or customer lists or things like that as assets. You can't just wake up one day and say, hey, I think our brand is worth $1 billion and slap it on the balance sheet. And this quote from the Standard explains exactly why. It says it's basically impossible to separate the money you spent building your own brand from the money you just spend running the business every day, right? How much of your ad budget was for long-term brand building versus just trying to make sales this week? It's way too subjective. The only way a brand like that gets onto a balance sheet is if you buy another company that already owns it.
This all boils down to the idea of internally generated goodwill. This is that amazing reputation you've built up, the loyal customers who love you. It's incredibly valuable, of course, but it is not an asset on the books. Why? Because it fails that very first test we talked about. It's not an identifiable resource you can separate from the business itself.
Okay, so we've waded through all these rules and tests. Let's zoom out a bit. Why should we even care about all this? What's the big picture here?
Well, here's why it matters. For investors, these rules help them see a company's true value a little more clearly. For managers, it gives them a framework for making big decisions, like whether to build something in-house or just go out and buy another company. And really, for all of us, these rules are the best tools we have for making sense of an economy that increasingly runs on ideas and knowledge.
The key thing to remember is that while a company's balance sheet tells you a story, these rules mean it often doesn't tell you the whole story. This is a huge reason you see that massive valuation gap with big tech companies, where their stock market value is just trillions of dollars higher than their book value. Their greatest assets, the brains of their employees, their customer loyalty, all of that remains invisible on paper.
And that really leaves us with a final big question for the future. IAS 38 gives us the rules for today, but what about tomorrow? As things like AI, big data, and other digital assets become even more central to how businesses work, how will the very definition of an asset and the rules we use to evaluate need to change? That's the puzzle accountants are going to be working on for years to come. Thanks for tuning in.